Good morning, everybody. Thank you all for joining me this morning. For those of you that are in Ontario, good afternoon. I'm extremely excited to come on here today. This is the first webinar series that I'll be hosting, and really the purpose of these series, guys, is we're trying to equip our broker partners with the additional tools so they can apply them in their business and with their clients. In these series, what we'll be doing is I'll be covering a wide array of different topics from our product offering. We're going to be running through some commercial workshops, residential workshops, running through live deal scenarios, really while keeping you guys updated with the most recent market and industry trends. For today's session, for those of you that didn't attend the MPC conference, my president and I, Mike Forshee, had presented in one of the concurrent sessions on Saturday morning, and our topic of conversation was going beyond the deal and understanding the importance of your lender lineup and how that impacts you as the broker. So today, what I wanted to do is do a quick recap of our session, and then I wanted to open it up to a Q&A at the end. Really, today's session will be anywhere from, call it, 15 to 20 minutes. And really my goal is to peel it back, understand the little things and how they can be so crucial for you as a broker to make better informed decisions for your client and your business ultimately, and knowing the funding capacity of your lender lineup. So at the end of the day, really, the question you should be asking yourself is if you're sitting down with your client and they ask you, where is my lender's funding coming from? You should have the answer for that. So that's what I'm going to be diving into a bit more detail today, and why it's important for you as the broker to understand. So to kick it off, we understand that different lenders determine risk differently, and they raise capital differently, depending on how they're financially structured. So, within the alternative lending segment, you have two different lending sources. You have a mortgage originator and you have a balance sheet lender. And what I'm going to do is go through and compare the two. So a balance sheet lender essentially they're typically a larger financial institution, and they fund their loans from their own capital, and they retain those loans on their balance sheet. And they manage all aspects of the loan, from underwriting to funding and to the servicing of the loan until that loan is either repaid or it's refinanced. Comparatively to an originator, they typically are funded by third-party investors or a pool of investors, and they generally sell those loans once they originate them, and they don't retain them on their balance sheet. So this enables the originator to originate more loans without having to carry those associated capital burden that a balance sheet lender would. So knowing this really gives us a better understanding and distinction between the two. And really what I wanted to do is dive into a bit more detail and understand the differences of both. So starting out with, how does a lender get the return or the revenue? A mortgage originator would get the revenue from the fee, comparatively to a balance sheet lender who would get it from the margin or the spread. When you look at no capital versus capital impact, what does that mean? So essentially, originators, they typically raise their capital from a pool of investors, as I mentioned, whereas a balance typically get their funding from their own source, which they hold on their balance sheet. So the challenge here that a lot of mortgage originators have is that they're heavily reliant on third-party investors, and you run into issues where that particular investor may not have that capital readily available to invest in a particular deal, or maybe they may be a bit more selective on the type of deal that they want to invest in. When that can pose a challenge for you as a broker when your client needs that capital readily available. Comparatively to a balance sheet lender, they typically may pose more stricter credit requirements and underwriting policies. However, they always have that funding always available. And they also oftentimes do have a more diverse set of funding solutions available. Now, one-time revenue versus ongoing revenue, what does that mean? So originators, they generally receive a one-time single payment from the fee when the loan is successfully funded. So that provides immediate capital for that lender. However, there's no future income that's associated with the loan. And the originator has to constantly provide or have deal flow to maintain steady revenue. Comparatively with a balance sheet lender, they generate revenue on an ongoing basis, as long as the loan remains active. And they're typically paid as a percentage of the loan balance over a duration of time. So you maybe ask yourself, Jake, that's a lot of information to process. But what does that mean for me as a broker? So let me explain to you that in a bit more detail. So the benefits for you as a broker in understanding where your funding capacity is coming from is number one is that it's a reliable liquidity source. So you know that, for example, if you have a lender with a high funding capacity, they're less likely to experience issues with, with closing the deal. And they can accommodate those tighter deadlines. They can accommodate those complex financing needs. And you know that the capital is going to be there, and you don't have to worry about having to, find a new solution at the last minute. Access to quality options. So understanding your lender's financial structure allows you to, create competitive offerings and for your clients. Oftentimes, they're able to provide more tailored solutions. They can, offer more higher loan to values with more flexible term options. And lastly is client trust and security. So, when brokers understand the lender's financing capacity, it limits the second guessing for you, and it also improves your efficiency as a broker. You're positioning the solution up front with the client, and you know that the deal is going to get done. It allows you to almost to turn and burn some of these deals and move on to the next one, which ultimately improves your efficiency, and more commission for you in your pocket at the end of the day. Risk of not understanding. Now, the potential risk of not knowing your lender lineup or your funding capacity of your lender is, potential industry risk or potential industry reputation. So if a lender unexpectedly pulls back their funding constraints, this could, the client could face delays. It could incur, additional costs, and they have to go out and search for a new lender. It also puts your client, in the wrong options. This can impact, your client with an unsustainable payment, excessive fees, can create a cycle of high interest debt, loss of equity within their home. And ultimately just puts more emotional stress on that particular client, which hurts your reputation moving forward. Lastly, I really want to hone in and really go through why funding capacity is important. And I've kind of categorized it into five impacts. And by understanding how your lender raises capital, how they deploy it, can really influence the terms, the rates, the chances of renewal with that particular lender. So I'm going to dive into that in a little bit more detail, starting off with fees and pricing. So certain lenders, they may have higher operational costs, and they rely on different funding sources compared to other lenders within the space. So to cover those costs and then to ensure that they maintain profitability, they may impose higher fees on borrowers, even though their rates may be a bit cheaper. So one thing I want to emphasize is that really understand the commitment and read through the fine print when you're looking through it. You could have one unique scenario that your client has, and you could have two lenders that can provide that same solution, but they could be two completely different offerings on paper. So really reading through the fine print and understanding what it is that you're putting your client into. Next is renewals. So lenders with a strong funding capacity, they're generally more likely to offer renewal options for clients because they don't have to turn over that capital as quickly as an originator would, and they can keep the client on the books for a longer period of time. So as I mentioned, it kind of goes hand in hand with fees and pricing, but really reading through the fine print, understanding your client's client scenario, and making sure that it's not, you're running a cost analysis between the two different commitments, but really ensuring that you're reading through it, and it's not just about the rate, it's the particular solution that you're trying to provide for that client. Next is product offering. So a high funding capacity lender allows the broker to diversify their product lineup and fill specific niches and gaps within the market, and for their clients. So for example, if you have a business for self client who has difficulty in providing the traditional income docs for a conventional lender, by having an understanding that there's a lender out there that can provide a stated income program that can accommodate that flexibility, that not only allows you to accommodate your client's offering, but it improves your efficiency. It allows you to not second guess and ultimately move the deal on a lot quicker. Next is term. So understanding the difference between what a high funding capacity lender can offer from a term perspective versus a low funding capacity lender. So I'm going to go into that in a little bit more detail here. So a lender with a high funding capacity, they typically have the ability to offer more flexibility in their terms, and they can include longer repayment histories. And this can benefit the borrower by allowing them to better manage their cash flow. Versus a low funding capacity lender, they have limited funding, which may result in lenders actually offering shorter terms to minimize their exposure and for quicker capital turnaround. So, not saying that either is right or wrong, but it's just understanding your client's scenario and what it is that you're putting your client into. Specifically what we see here at Glass Lake, we see a lot of real estate investors. So oftentimes these investor clients are coming to us because they're capped on doors with another financing institution. So by giving the client a term solution, it allows them to scale, to continue to scale their portfolios, but they have the peace of mind at the end of the day, knowing that they have a stable funding source for over the next few years. So to conclude, just one of the key takeaways that I wanted to mention here is just really understand and ask yourself, how is your lender funded? I think with a deeper understanding of how each lender's financially structured can minimize the second guessing and ultimately saving time for you as the broker and for your client, but also streamline your decision making. When we have more clarity on how these lenders' financial models work, we can make better informed decisions, for our clients and ultimately strengthening, your reputation within the industry. So one thing I ask is I encourage all of you on your next deal, make sure that you're really understanding, reading through the fine print, understanding your client's scenario when you're positioning, the lender or solution in front of them. So today, I hope you guys gained some valuable insights. And now what I wanted to do is open it up to a Q&A. If not, please shoot me an email or give me a call at any time, and we look forward to hopefully working with you on your next deal.